The Fed has finally pulled the trigger on rate cuts, but is this the start of a bull run or the first step towards a crash? Should you invest more now before a bull run or wait for a crash and buy the dip? I will not answer all these questions this time. I will let the top players in this game answer these questions, especially after this rate cut. I will show you the answer of the senior managing director at BlackRock, and I will show you the answer of co-head at Goldman Sachs and top tier hedge fund managers at huge companies in the US. All those professionals you're about to see, they are responsible for overseeing and growing people's wealth, with some of them managing investment portfolios worth over $1 trillion. So let's start. But before we start, I would like to introduce myself. My name is Mohammed. I started investing 6 years ago when I took a huge hit and lost all my money on crypto because I was buying meme coins hoping they will be the next Bitcoin like everyone else. I learned my lesson the hard way. In the year 2020, I started investing instead of gambling. I started buying value stocks at good times and analyze undervalued stocks, and that's when I doubled my money in 2021. And in 2022, I bought these stocks at these prices and doubled my money again by 2024. I went from 5 figures to 6 figures in only 4 years. And now I bought these stocks at these prices as I think they will double in the next 3 years. The mission of this channel is to hit our first $1 million together. I'll be sharing what stocks I buy in the upcoming days, and I will give you a weekly update about my portfolio. Currently, I'm sitting at $206,000. Let's start. We will start with the famous Tom Lee, who is the co-founder and head of research at Fundstrat Global Advisors. He was asked what will happen to the stock market if Fed continues cutting rates. He answered, he is bullish as he thinks the market will continue to rally without inflation. Take a look at what he said.
So does that mean if the Fed stays dovish or keeps cutting that there's other newer legs to this pretty remarkable stock rally?
Yes, and I might even say that I think that we could have growth recover without inflationary pressures. I think reflexively, people the last few years think growth picking up means there's automatic inflation. That has not been the case for 25 years. But I think if companies begin to expand, plus the fact that we know AI is driving productivity gains, and that's really a big tailwind for businesses, and then we know that there's initiatives around Wall Street boosting productivity because they're going to build on the blockchain, I think there's a path for growth to be stronger next year without a pickup in inflation. That's going to be very good for profits and for equities.
Our next analyst is Rick Rieder. Rick is the senior managing director at BlackRock, one of the world's largest assets managers. He handles a huge portfolio managing trillions of dollars of fixed income assets. He was asked, how far can we go with this rally? And he answered that we are in the best investing environment ever. And he thinks that the rate cut will not have a significant impact on stock market, and he thinks the market will continue to rally. Take a look at what he said.
With new questions about how far this rally can really go. Let's ask Rick Rieder. He is BlackRock's CIO of Global Fixed Income. It's head of its global allocation team as well. And as I said, he is with me here at Post 9. It's good to have you back.
Thanks for having me.
I tell you, you sent me an email earlier. I had to do a double take. You said this is the best investment environment ever.
I think that.
You mean that?
I do, and by the way, it doesn't mean necessarily everything's going up, but there's a couple of things at play that are pretty extraordinary. First of all, if you take the equity side, first of all, the technicals and equities are crazy. I know we've talked about it before. Amount of cash on the sideline, the amount of buybacks relative to the IPO calendar, i.e. the demand versus supply, is pretty extraordinary. And these companies, we've talked about on the show, the multiple is not that attractive. These companies are throwing off the earnings growth. So I looked at 2024. If you strip out Tesla for obvious reasons, Mag 7 year-on-year growth is like 54%. You get through multiple pretty quickly when you're growing that fast. Then you take the other side of it is you've got in fixed income, you're getting yield levels. Listen, I think the Fed can cut rates, but until then, you got yield levels. You can create portfolio 6.5%, 7% yield. That's pretty good. I would throw one last thing. Today, volatility, you don't have to necessarily, one of the things I always think about, what's your exit strategy? What's your escape hatch if you get something surprising? The volatility, the equity market, we did a trade today, equity vol, I think it was 10 vol, 9.5, 10 vol to own, like crazy low volatility to own equities. So you don't actually have to take the downside risk. So that's a pretty good environment.
Our next analyst is David Tepper. David is the founder and president of hedge fund called Appaloosa Management. David is known for his bet back during 2008-2009 crash when he betted on financial assets that recovered and made massive profits back then. He was asked about his opinion about the recent rate cuts, and he answered that he thinks the market will not crash. Also, it will not rally because we are in a good economy, signaling that we are in a kind of expensive market already. However, he warned about easing too much can start a crash. What he meant by too much is three more rate cuts. Take a listen to what he said.
The Fed cut yesterday first. Is it the beginning of it?
I noticed it. I did.
You were watching this morning. You watched Frank Holland talk about it. Is it the beginning of an easing cycle?
Well, look, I mean, they eased yesterday, and I think the market knows there's another ease coming. Could be two more ease coming. That's what's in. I don't know what's in there this morning, but and you're easing, at least those eases are into as you just saw numbers out, not in a bad economy. And look, I don't know how long that lasts, and we're not at cheap levels in this market. On the other hand, when they eased after long-term capital and then they used to get into Y2K, I mean, we weren't in a bad economy then, and the market went a little bit nuts. I'm not saying the market's going to be nuts now, but, and by the way, the other side of that was a disaster, okay? Mm-hmm. So, I mean, I don't think another ease matters, as far as being too easy. It's going to be a little bit restrictive. Or even if they do two. Beyond that, it's going to be a little tricky, I think, because you got to be careful not to make things too hot to have the other side of the mountain, which was really freaking ugly, in 2000, 2001, etc.
Our next analyst is Mina Flynn, who is the co-head of Global Private Wealth Management at Goldman Sachs. She was asked about her prediction of the stock market after rate cuts, and she said that she is encouraging all her clients to stay invested in the stock market. However, there is an 80% probability that the S&P 500 will drop 10% over the next 12 months. Take a look at what she said.
Joining me now is Goldman Sachs' Mina Flynn. Mina, it's great to have you on the show from the private wealth department. What are you telling your clients at this point now that we have seen such a strong melt up in stocks?
Absolutely. We're encouraging our clients to continue to stay invested and with incremental capital to really look to put that to work over a 6 to 18 month time period. And we are expecting drawdowns. So whenever you've got a market that's at the 10th decile, such as what we are now, it is likely that you're going to get a drawdown. In fact, there's an 80% probability of a 10% drawdown. That being said, valuations aren't the best predictor of what forward market performance is going to be. So we've been in that 10th decile since December of 2016. And since that time, the market's actually returned 200%. So we're really focused on earnings.
I shared an insane graph in this episode that shows the historic performance of the stock market after rate cuts back in 1995, 2001, 2007, and 2019. This will give us some prediction what will happen to the stock market, so watch this episode.